Have you ever wondered how to invest in stocks or real estate? As we journey through life, we often find ourselves pondering such questions. The world of investment is vast and diverse, offering a myriad of opportunities to grow your wealth. From the bustling stock market with its ever-changing ticker symbols to the more static yet lucrative realm of real estate, each option holds its unique allure. But that's not all. Have you heard about ETFs or exchange-traded funds? They're akin to mutual funds but trade like stocks on an exchange. Speaking of mutual funds, they pool money from many investors to purchase a diversified portfolio of stocks, bonds or other assets. And then there's the digital frontier of cryptocurrency, a relatively new addition to the investment landscape, offering a whole new way to participate in the financial world. Stay tuned as we unravel the secrets of each investment option. We're just getting started and there's a lot more to explore. Investing in stocks might seem daunting, but it's simpler than you think. Let's break it down. Investing in stocks essentially means buying shares of a company. When you buy a share, you're buying a piece of that company. You become a shareholder, sharing in the company's profits and losses. Now you might ask, how do you decide which stocks to invest in? This is where market research comes in. It's crucial to understand the company you're investing in, its financial health, and its growth prospects. You don't have to be a Wall Street guru to do this. There are plenty of resources available online to help you analyze stocks. To start with, look at the company's earnings reports. These give you a snapshot of the company's financial health. Next, look at the company's forward-looking statements. These provide an idea of the company's future plans and growth prospects. Keep an eye on industry trends too. If a sector is booming, companies in that sector could be good investment options. Once you've done your research and picked your stocks, the next step is buying them. This is done through a brokerage account. There are many online brokerages available today, each with its own features and fees. Some brokerages cater to beginners with easy-to-use platforms and educational resources, while others cater to more experienced traders with advanced charting tools and research capabilities. When you open a brokerage account, you'll need to deposit money into it. This is your investment capital. You can then use this capital to buy stocks. The process is as simple as searching for the stock on your brokerage's platform, specifying the number of shares you want to buy, and clicking buy. It's important to remember that investing in stocks is not a get-rich-quick scheme. It's about long-term growth. The value of your shares may go up and down in the short term, but over the long term, they're likely to increase in value. This is because, in general, companies grow over time, and as they grow, so does the value of your shares. Remember, investing in stocks is about long-term growth, not immediate profits. So, get started, do your research, be patient, and watch your investments grow over time. Scene Script, exchange-traded funds, or ETFs, offer a great way to diversify your investment portfolio. Diving right into it, ETFs are essentially baskets of securities that are traded, much like individual stocks on an exchange. They're designed to track the performance of a specific index, sector, commodity, or asset class. They've been around since the early 90s and have grown in popularity because of the diversification they offer. When you invest in an ETF, you're not just buying a single stock or bond, you're buying a piece of an entire portfolio. This broad exposure can help to reduce risk. Think of it as not putting all your eggs in one basket. Instead, you're spreading them across a variety of baskets, each representing different sectors, industries, or types of investments. Now, how do ETFs work? When you purchase an ETF, you're buying shares of the overall fund, not the individual securities within it. This means you can potentially own a piece of hundreds or even thousands of stocks or bonds with a single purchase. This is quite a contrast to buying individual stocks, where you're heavily reliant on the performance of a single company. So, how do you invest in ETFs? It's quite straightforward. You can buy and sell ETFs through a brokerage account, just like you would with individual stocks. The price of an ETF's shares will change throughout the trading day as the shares bought and sold on the market. But here's something to remember. While ETFs do offer the benefit of diversification, it's still wise to do your homework before investing. Look at the ETF's holdings, its performance history, and its expense ratio, which is the cost to manage the fund. And like any investment, it's important to consider how an ETF fits into your overall investment strategy and risk tolerance. ETFs can be a valuable part of any investment strategy, offering flexibility and diversification. With their ability to provide broad exposure to different sectors and asset classes, they can be a solid choice for both new and experienced investors alike. Mutual funds offer a convenient way to invest in a broad range of assets. Mutual funds, in essence, are a pool of money contributed by multiple investors. This pool is then managed by a professional investment manager who uses it to buy a diverse range of stocks, bonds, or other assets. This diversity is one of the key advantages of mutual funds. It allows you to spread your investment across numerous assets, thus reducing the risk associated with investing in a single asset. Think of it as not putting all your eggs in one basket. Investing in mutual funds is often likened to buying a slice of a large pie. Each slice or unit represents your share in the fund. The value of your unit changes in proportion to the fund's overall performance. If the fund does well, the value of your unit increases and vice versa. So, how do you go about investing in mutual funds? First, you need to identify your financial goals and risk tolerance. Are you saving for retirement or a down payment on a house? Are you comfortable with high-risk, high-reward investments, or do you prefer a more conservative approach? Once you've answered these questions, you can begin researching various mutual funds. Look for funds that align with your financial goals and risk tolerance. Also consider the fund's past performance, although remember, past performance is not always indicative of future results. Next, you'll need to open an investment account, either through a brokerage or directly with a mutual fund company. From there, you can buy units of the fund. Some funds require a minimum initial investment, while others allow you to start with as little as a few $100s. The beauty of mutual funds lies in their simplicity and accessibility. You don't need to be a financial expert to invest in them. Plus, you're delegating the task of analyzing and selecting individual assets to a professional manager. It's a hands-off approach to investing that still offers the potential for solid returns. With mutual funds, you can leverage the expertise of financial professionals and diversify your investments with ease. Real estate is a tangible asset that can provide steady income and potential appreciation. Now, when we talk about real estate investment, most people's minds go straight to buying rental properties. This is indeed a popular method. You buy a property, rent it out, and voila, you have a steady stream of income. However, it requires significant capital and hands-on management. If that's not your cup of tea, let's introduce you to real estate investment trusts, or REITs. REITs allow you to invest in real estate without physically owning a property. It's like buying stocks of a company, but in this case, the company invests in real estate. REITs are required by law to distribute at least 90% of their income to shareholders, making them a great source of regular income. If you're looking for something a bit more modern, real estate crowdfunding platforms might pique your interest. These platforms allow you to invest in real estate projects with other investors, splitting the cost and, of course, the profits. It's a great way to get involved in larger real estate projects without needing a hefty bankroll. Remember, each of these methods carries its own risks and benefits. It's crucial to do your own research, maybe consult with a financial advisor before diving in. Real estate investing can be a lucrative venture if done correctly, offering both income and potential appreciation. Cryptocurrency is a relatively new and volatile investment option that can offer high returns. It's an entirely digital form of currency that uses cryptography for security, operating independently of a central bank. You might have heard of Bitcoin, the first and most well-known cryptocurrency, but there are thousands of others, each with its own unique features and uses. Now, investing in cryptocurrency isn't like buying stocks or bonds. It's more akin to buying a foreign currency. You purchase coins or tokens of a given cryptocurrency, hoping their value will increase over time. So how do you invest? First, you'll need to set up a digital wallet to store your cryptocurrency. There are plenty of apps and websites that can help you do this. Next, you buy your chosen cryptocurrency through an online exchange, using traditional money. Some popular exchanges include Coinbase and Binance. But here's the catch. Cryptocurrency is notoriously volatile. Its value can fluctuate wildly from day to day, even hour to hour. This volatility can lead to significant losses, but it can also lead to enormous gains. To mitigate the risk, it's crucial to do your research. Understand the technology behind the cryptocurrency you're interested in, and keep an eye on market trends. And remember, never invest more than you can afford to lose. Though risky, cryptocurrency can offer significant returns for those willing to navigate its volatile markets. Investing can be a powerful way to grow your wealth over time. It's a statement that we've explored in detail today, delving into the intricate world of investment options. From stocks, a classic choice that offers the potential for high returns, to ETFs, which provide the advantage of diversification. We've also discussed the stability of mutual funds, a reliable choice that can act as the backbone of any portfolio. Then, there's real estate, a tangible asset that can provide both income and appreciation. And of course, we've touched on the contemporary world of cryptocurrency, a volatile but potentially lucrative frontier for the brave investor. Each option has its own unique set of benefits and risks, tailored to different financial goals and risk tolerances. It's up to you to decide which path to tread, armed with the knowledge we've shared. Remember, the best investment strategy is one that fits your financial goals and risk tolerance. Happy investing!